Good morning, ladies and gentlemen. Well, what a very interesting week we've had. When we take everything into consideration, we're still at 73. We had a very brief interweek dip, as I thought we might, but I thought it might continue. But as you can see from the scores after the 39 on Wednesday, we bounced straight back up to 73 and closed nearly unchanged on the week. If we have a look on the weeklies, the change is minute. So we've proven the worth of the levels that I've given you, and we will revisit those in detail, but still no definitive sign of a even slight risk off. And therefore we have to respect what the market is telling us. Let's have another look at what bonds have said this week, and then we will see the shifting pattern of the equities first, followed by gold, followed by bonds in terms of asset allocation, because I really think that those are beginning to shift, and we'll have a look at the levels that will confirm the shift is indeed taking place. 2s10s tried very hard to break up to the upside towards 158. Failed. We are now at this inflection line around 147, 148 basis points. And I think the next move is, more likely to come to the downside than the upside, having, had the kitchen sink thrown at the market, and it held. But as always, I'm going to be guided by price. If we start reversing up towards 158, that is quite bearish for bonds. I just don't expect that to happen for a while yet, simply because we've had the auctions, we've had the bad data in terms of CPI and PPI, and the market has held. That tells me that we need some more data inputs for the market to turn, and we are not having any next week. Nothing significant is coming next week, which I think is, it's more likely to meander between something like here, 141 up to 152, 153. So I see no overwhelming risk reward in the yield curve at the moment. I think it's going to take, the fact that everybody keeps on screaming from the Fed, and I don't know if you've noticed that at least 5 of them are out every day, every single day, not one, but 5 governors come out and scream transitory at inflation. Well, the market is confused. The market is unable to take a direction and hold it, simply because they are doing their thing. They are manipulating the market, and they want to manipulate the market, so it's going to take some more time. Every part of the yield curve has come into some kind of support and is now waffling around. If we have a look at the weekly chart of 530s, it's gone right back to support at 154. I mean, you can see how important this support at 154 basis points is. Through it, and we have nothing, absolutely nothing, until we get down here around 192, 193 basis points. So you can see how very, very important that is, and we will be guided by it. I personally think now it's more likely to go 2 or 3 basis points, less steep than more steep, just like the 2s10s, and this is a daily chart of it. It's right at the inflection. Probably go down to 150, something like that, before we start going again. I think the market, as I said before, is confused and really doesn't know what to make of the Fed. The really important one also is 10s, 30s. As long as 10s, 30s stay in this range between 64 and 80 basis points, that is telling you that the market is not losing confidence in the Fed. The Fed can manipulate the shorter ends, it can manipulate probably all the way out to 5s and 10s, but it really begins to be very, very hard to manipulate 30s. Unless they start doing some sort of operation twist. I know there are rumors of it. I just don't believe that they will do it yet. I think that would be a sign of desperation. I think the market would read through that. As long as we stay in this range, the market is not losing confidence in the Fed. When we see a sharp move down in 10s, 30s, I think that will be the sign that the market is beginning to lose confidence. If I was the chairman of the Fed, I would be patting myself on the back after this week. I think they've managed to do exactly what they wanted to do, and that is put the market to sleep. With all the data they had and the auctions, they managed to get through the week relatively unscathed. I mean, you know what, a handful of basis points higher after the kind of data they've had is, I think, a very, very good result for them. Now, when will the market start, moving? Well, I think that this inflection point here now becomes very, very important. 89 basis points on the 5s. I think not until we start seeing the market going higher than that is the market in trouble. If we have a look at 10s and we enlarge a chart of 10s, I think the equivalent level starts being here. We need to close higher than 169 basis points to start being worried in the slightest about what is going on in 10s. And 30s are going to be my bellwether all the time. And I just listened to an interview with Gundlach, and I agree with him. I think the market is really now, what it's saying is that if we start taking out 251, that is when we start getting into trouble, and that will be a screaming sign that the bonds are going higher. Until that happens, and look where we close. We close below 237. I think it's more likely that they squeeze people, and basically over the next few days we trade in this area here, which indicates that nothing much is going on in the bond market. If that happens, I think that the risk reward then starts shifting for gold, just like gold was in a bear market because of the real yields going up. I think now there's a danger that it goes into a bull market because real yields are actually going down. The market that is much easier to trade is actually the European bond markets, because the narrative there, I think, is actually clearer at the present time, and that is that the vaccinations are going much faster. The spread against the United States, therefore, can be caught up. The US has already made its move in terms of yields. It's now a question, does it continue that trend, or does it just stick around for a while and finds out whether indeed the inflation is temporary? In the meantime, the European markets can continue their catch-up trade. You can see how well they're trading against our levels. They get to a level and then they go up. This is the bubble, and it closed right around this 52 area, which is so important. But the bubble, the yield curve is definitely steepening. The bubble is the one that's moving less. This is the 10-year Bund, and you can see that this is the one that actually is moving most. I think that this close through 17 is significant, and that we're going over the course of the next couple of weeks. This is a weekly chart towards the 05 level. If we turn that into a daily chart, you can see where the support, where we probably want to put a trade on, is around here, 17 basis points. If that fails, we average down towards the 22 basis points. I think the odds of it going through 22 are very, very low. And then what we should be looking for is the move that takes us all the way up here to around the 5 basis points. You can see how you really have to look on a weekly chart to see that we are doing a very nice cup and handle, and you can see how important this area between -17 and -5 is. I think it's going to be very difficult to go through -5, but I certainly think we get there. Italy is the chart actually that's performed best, as I said it would. And here we're looking at 113 basis points would be the equivalent of where we are when we get to -5 in the Bund. France is also very, very clear. It's reached its first objective, which was here at what is that, 28, 29. It's now more likely to come back, as I said, around this 14, 15, and that will be another opportunity to take a trade, because I think eventually it breaks up and goes towards this 59 level. It's much clearer in the OATs and in the BTPs. Those are my contracts of choice, and every time it backs down towards a support line, that is where I want to put my trade on. If we look instead at the differential between the bunds and the treasuries, who would have thought that after all the data we had last week, we would have only moved, net 2 basis points? It just shows you that we are basically stuck, with 175 as support, and, resistance is here, 182, 183. So I would expect next week to be quiet in this spread as well, which basically tells me that at different times the European market will go better, and really, if we go back to the chart of the bunds, since I'm expecting the differential to be fairly constant, and I'm expecting tens to do not very much, we are likely to see the market here between -22 and -17 for a reset to go higher. So I'm going to be very patient next week and really look for good levels to short bunds. I don't think bunds are going to run away, not next week. Made quite a bit of money being short of bunds and OATs and BTPs, and it's really a question of being patient again and looking for very good levels to put the trade back on, because I don't think these trends are over. I think they're just going to churn around for a while and try to figure out what this word transitory actually means. The US dollar has also gone to sleep with the differentials between US and Europe remaining constant. There seems to be absolutely no big push from or pull from either side. It's likely to remain in a tight range even next week. So the best thing to do is actually to enlarge a daily chart and see what is going on there. Support is very clear at 89.80 and 89.41. I think those levels are going to be very, very difficult to break over the course of next week. To me, it's more likely to try to the upside again, but there 91.41 is very, very clear as a resistance level. Through there, and you have to start asking yourself what the hell is going on. But I just don't see it. I think next week in the dollar as well is going to be a very quiet week, just as I think it's going to be fairly quiet in bonds. I want to concentrate on gold because I'm getting the feeling that the risk reward here is shifting. Why would it be shifting? And I'm not 100% clear in my own mind, but my narrative is beginning to be something like this. If we had a push higher in yields, and that was bearish for gold, which I told you it would be, because real rates were going less negative, i.e. more positive. Then if the bond market is now lulled into a sense of sleep by this transitory word that the Fed keeps repeating 5 times a day, it's going to take a long time for the, or relatively long time for the bond market to regain steam if it is not transitory. And that allows a better performance by gold if the inflation hawks now start coming out and really pointing at different things and saying inflation is definitely here, this is not transitory, and the bond market's doing nothing about it. So it's counterintuitive, but we are beginning to get the macro narrative that could push gold significantly higher. And I don't mean 1 or 2%. I mean, dozens of percentage points. When will we know that that is happening? Well, I don't know, to tell you the truth. Don't know really what to tell you, but I'm just getting in my water the feeling that there is the possibility of this shock shift. And the best I can do really is say above 1881, I start thinking that we are beginning to get the beginnings of a move that's going to take it to new highs. In the meantime, this 1763.45, whatever it is, level is going to, I don't think there's any chance of us breaking down through it. I think now the danger is that we start taking out 1881 and we start going higher, simply because if bonds won't do the right thing, because they've been lulled to sleep by the Fed, and market participants are so uncertain about what to do, that leaves a door open for gold to actually be the conduit for doubt. That's all I have. I mean, it's not a knowledge that I have, it's just a feeling that I'm getting that risk reward is shifting. And I will look at a few spreads now to see why that might be so. Here we have the spreads of gold against SPY, and here we have it against TLT. You'll remember this line, and this is when, if you remember, this was, I don't know what it was the second quarter of last year, when I said that breaking this line is going to be very significant. And that is when I started saying equities followed by gold, followed by bonds. It's just continuing. I mean, gold had the best week of everything, it was better than equities and it was better than bonds. So I just get the feeling that instead of having the equities followed by gold, followed by bonds, we could now be shifting towards gold being at the forefront. It's just a feeling, but I think the risk reward is beginning to change. I think that when we start breaking below this line around 236 and heading towards this 220 to 16 level in SPY gold, that will be confirmation. And I think that then we will be making a very much a topping pattern that allows gold against SPY to come down here, which would be a very, very bullish sign for gold. Again, early days. I just want to make you aware of my change in sentiment towards gold and the fact that I will be looking for option plays every time it comes back towards 1765. The other thing that makes me consider that I should be bullish in gold is now this chart of gold against copper. We've gone and we've tested the absolute all-time lows in that spread, and we are coming back. Now this squeeze, as you can see, is sometimes very violent in gold copper. If you look at this period around 2014 and earlier in 2012, I think down here it's like trying to push a ball underwater and you could get a rapid move. Now the question then becomes, is copper going to collapse and gold do nothing? I think that's unlikely. I think it's, although copper might, give up 3-4%, it's more likely that as copper gives up something, gold gains something too. And that is why I think it's actually more likely that the impulse for gold is going to be positive rather than just less negative. Could easily come back towards this kind of level. Very, very easily around this 870, 880. And that to me probably would give gold the impulse to break higher above the 200-day moving average and take out those levels that we mentioned around 1881. So just that you know, I have quite a few reasons to start thinking that gold has probably seen its worst, and it could have, at the end of the day, some very considerable upside, but in the meantime, certainly upside. If last week proved anything, is the relevance of these levels, of all three levels actually. I think it's amazing how the market came back after testing the 4068 level, just gapped all the way. All it did was pause at 41.29.48 for half a day, and then opened above it and never looked back until it touched exactly 41.80. Now, what happens from here? Who the hell knows? I am just so uncertain. I have a narrative in my mind which is bearish, and I have the evidence of my own eyes which is not bearish. This is just not a bearish formation to me. Could it become a bearish formation? Of course it could, but it needs to break down below and close below 41.29 and then 40.68. Do I think that is likely next week? Probably not. Simply because if I think that the bonds aren't going to be leaders, I don't see what is going to make the equities collapse all of a sudden. Now, could some piece of data, some piece of news come out? Absolutely it could, but I'm not going to rely on that. So basically, the evidence points to higher prices, and any close above 41.79.89 is actually telling me that we are more likely to test the upside of the Bollinger Bands. Now that's a 195-minute chart, but if we go and have a look even at a weekly chart and work backwards, you see the importance of 41.29 there. I thought we would close below it, and then it's actually would have been quite simple. We go down to the next support level at around 39.40 and look for a violent bounce back up to 41.29. But the market is going to make it hard. I think only a weekly close below 41.29 is actually bearish. Everything else actually offers us the opportunity to go up towards the 4,300 on the Bollinger Bands. And if we look at it daily, we will see how, the market could not stay below the Bollinger Bands. If we enlarge this, I think that would be a good idea. We have some very supportive MAs underneath. We have the Bollinger Bands, which did not keep up and expand, but now are supportive. And say that we are unlikely to break anywhere around 40.70. To me, that leaves more room to the upside than it does to the downside. Now, if we go down to 41.29 and are unable to break it, I will definitely be looking for upside there. I just don't see why you wouldn't. The narrative seems to be there is just so much liquidity around that every time the market comes down, there are walls of money ready to snap it up. And until that changes and only closes below levels will change that. In all time frames, and especially the weekly, you have to say that the market is not done going up. If we look at the transports and the Dow Industrials, we can actually see that they've done nothing wrong. Nobody's going to tell me that this is a bearish pattern, and nobody's going to tell me that this is a bearish pattern. To me, until all these indices are ready to break lower and start breaking lower, the moves in SPX can only be transitory ones and spread ones. So until I start seeing something bearish out of transports and out of DJI, I have to give the benefit of the doubt to support levels in SPX. And I have to just admit that I was plain wrong thinking that it would close the week below that 40.68, 40.70 area in SPX. As simple as that. You can be wrong, but there is no need to stay wrong. Until I start seeing these changing pattern, and it's going to take time for these patterns to develop, I have to start saying that really there isn't that much downside in any index that I look at. Even the least bullish index, which is actually NQ, is not that bad. I mean, it's what's it done? 1, 2, 3, 4 weeks of selling off, closed back within the last week's range, right at the lows. All it's done is basically consolidate. This is just a consolidating pattern. If we get rid of the weekly chart and we have a look at a daily and 195-minute chart, it's come back exactly to where it would, it's supposed to go down to. Came down, tested where the gap was, rejected higher. Easily 13,717 before it starts coming back down. It's just holding all the important levels, and it's doing, it's the weakest of the indices, don't get me wrong, but it's even the weakest of the indices is not doing that badly. You can argue that this was an ABC and now we just consolidate a bit and go up above 14,000. Why not? It it basically is trading very technically. It's doing exactly what it should do, and it's not breaking down. A bit of sideways, and then it can become a leader again. If we have a look next at the technical spreads, the technology spreads, we will see actually that this is very healthy action. The technology spreads, they're saying that technology is the weakest, but it's not the end of the world. If we have a look at this chart of the Qs against SPY, support is not that far away, around here, around 76. It's just trading technically. This could be an A, B, C that gets down to there, and then we go again. It's just not saying that this is the end of the world. Even the most bearish one, here we have XLF against XLK. Well, it could go another percent or two, but that is all that it's really saying that we are doing at the moment. We are in a period of weakness for technology, but it's not that bad, and longer term it's okay. So really things are nowhere near as bad as I had thought or painted in my own mind. Reality is saying that even for technology, which is the weaker sector, things are not really that bad. The market that actually impressed me all week was Europe. It was much stronger than the States whenever the States were weak, and it closed right, almost unchanged, while the States were, down, 1.5%. To me, the path of least resistance for Europe is still up. If we have a look at this chart, I think we will see 15,700, something like that, fairly quickly. And I think every time Europe comes down, it's supported. To me, there is definite rotation going into Europe. To me, there's very little doubt of that. And I keep on looking at this chart and saying that we are almost bound to touch this kind of level, 4,113 in the stocks, and a rotation into Europe is long overdue. I think that given the fact that I'm bullish of Europe, given the fact that I think that the downside is very, very capped in Europe, I can't really be that bearish of the US. EM, nothing really has changed there, apart from the spreads, which we'll look at. But in absolute terms, it's doing nothing wrong and doing nothing right. It's still stuck between 52.08 and 55.83. But if you think about it, this probably is very close, if not at peak COVID panic in emerging markets because of their inferior healthcare systems. And when they come back, which they will at some stage, they are probably in a healthier position to retrace the spread than any other market. So I cannot change my mind that I'm bullish on VEM over the longer term, and as long as the market keeps on doing nothing wrong, i.e. staying above this area between 52.8 and 50.23, which I've made you aware of for so long, I just don't see why I should change my mind. On the spread basis, the interesting thing to me is that they've come back to FEZ. And this is, I think, going to be very interesting territory around here, around 107, and we're very close to it. I think that since I'm bullish of Europe, when we touch here, it will be the bottom in EEM. i.e. Europe will continue going up, but EEM will probably go up even more. So, mark this level. In fact, I'll mark it now. This is the kind of level that I think is going to be very, very important for the spread between EM and FEZ. And at that kind of level, I probably want to start shifting out of US assets because I'm still bullish on Europe and buy more EM. Finally, I think I love it when we get definition in markets, and that makes every play that I take that much more reasoned and actually with a better risk reward. 2005 has proven how important it is. It breaks above, you know, there is panic in the market. Look what it did. It went up from, what was this level, 21, 22, went all the way up to 28. And then in 2 days, straight back down 2005 on Friday, close 1880. That tells me, if you look at the patterns, what happens when the market comes down, it spends at least 2 or 3 weeks in the lower range before it starts doing the next spike. So I think that we probably have a 2 or 3 week respite in the market before we have another retest to the downside. Now, this gap here will be filled, okay? I mean, absolutely will be filled, but probably not for a couple of weeks, which would, it would tell me that next week and the week after are probably going to be rangy weeks in equity markets, spread weeks, rather than just directional. But I think the likelihood that we break below 41.29 in SPX is lessened by what VIX has done here, i.e. we need time now in this area before we do another spike. So in summary, I think next week is going to be a quiet and rangy week. I think you buy the dip and you sell the rip kind of thing. All the levels here are marked. There is nothing really new that I'm particularly looking at. The fact that VIX has closed below 2005 has just shown you, I think, gives me the real idea about what's going to go on next week, and that is probably not a lot. Still buy the dip. And that's why I have said I have no idea. I'm going to be guided by 41.29. Only a break and daily close below there will get me bearish in the slightest way. And otherwise, I will be looking over the course of the next 2 or 3 weeks that we get up into the high 4200s and test that kind of the Bollinger Band on the weeklies. I think that's my best idea, simply because I can't get bearish of Europe and I can't get bearish of EM, and therefore I have to be guided by 41.29. Thank you very much indeed, and tweet you on Monday.